So you have heard so much about people making a lot of money in stock market and wondering if you could do the same. Perhaps you have taken a few courses online or read a couple of books, but really didn't get the skills and understanding of how to invest in stock market. Stock trading has its own pros and cons, and believe me, you can lose a lot of money if you do not know what you're doing. You need to learn how, where, and what to trade. You need to learn how to read charts, financial reports, and many other things. That is why we bring you this course, Fundamentals and Basics of Stock Trading. Hi, my name is Imran Afzal, and I have been teaching for over a decade now. I have some of the best-selling and highest-rated online courses. I have my bachelor's from Baruch College and my MBA from New York Institute of Technology. For this course, I have collaborated with Ali Sheikh, who has many years of experience in stock trading. He will provide you everything you need to know about stock trading so you could make intelligent decisions and make ton of money. So let me introduce you to Ali Sheikh. Ali?
Thanks, Imran. My name is Ali Sheikh, and I have been trading and investing for over 20 years. I have professionally invested money for clients as a stockbroker and have worked at various investment firms in New York City. I had the opportunity and experience some great bull markets, but what taught me the most was failures during major bear markets, such as the dot-com bubble and Great Recession, when the market dropped over 50%. In the dot-com bubble burst, I had lost 80% of my account, but I protected all my capital during the Great Recession by avoiding losses. This course is to give you a broad overview on investing in the stock market and get you started on your journey to making money and avoiding losses. So with that, let's dive into the material and learn together. Are you ready to make money? Then let's go over this course, Fundamentals and Basics of Stock Trading. Now in this course, the first thing we will talk about in the introduction section is how to make money, what are the truth and reality of investing in the stock market, how you should be conditioning your mindset, and then we'll look at some richest people around the world and how they made their money, what are the differences between an economy versus a stock market, and how does investing differentiate while investing in stocks versus real estate or starting up a new business. Understanding what the sectors and industries are and companies within those sectors and industries. And then we'll talk about constructing a portfolio and opening up a brokerage account. Moving forward, we'll go over principles of investing, where we'll discuss what are the differences are between investing and trading, and knowing yourself what suits you. How much should you be investing? Setting your own goals, and after all said and done, if you make a little bit of money, how are you going to then minimize your fees and taxes so you can keep most of it? Then we'll talk about different types of investments, such as stocks or penny stocks, or understanding the difference between an ETF, which is an exchange traded fund, and a mutual fund, and should you be investing in dividend stocks which constantly pay you income, and you don't really have to keep buying and selling stuff. You can invest in it for long term and start generating some income via dividends. Then we'll talk about how to research and analyze that information related to your portfolio. We'll look at different business news. We'll look at some websites such as Yahoo Finance. Then what is the information available through your broker, and the information that's available on Twitter or YouTube, and how are you going to differentiate between people, whether they're providing you with valuable information or not. So you want to be very careful when you're following people online. After discussing that, we'll jump into fundamental analysis, which is looking at the financial statements of different companies and understanding their income and cash flow and how their assets and liabilities match up and whether it's a good investment or not. So we'll try to understand whether a stock is cheap or expensive and whether a stock is a value stock versus a growth stock. All these decisions matter when you're investing for yourself and for the long term. But there are other tools such as technical analysis that you can look at charts and price trends and make decisions whether it's a good investment, whether you should be jumping in or not, how to protect your capital. And all those things are very beneficial when it comes to technical analysis. And it will help you protect a lot of money during a downturn, and it will give you signals during an uptrend and allow you to jump in and make money. And then finally, we'll talk about retirement investing. How should you be saving for retirement? What are the plans that are offered through your employer, such as 401k, or the government might have some incentives such as IRA, which are individual retirement accounts, such as traditional IRA and Roth IRA. So after all said and done, you will be in a state where you'll have a broad understanding of stocks, economy, analyzing information, following business news, looking at charts, and making buy and sell decisions, and how to invest for the long term and protect your capital and have money when you need it the most. So let's dig deeper into it.
All right, in this video, we will talk about how to make money in stocks, and that's why you are here taking this course. So, before you invest anything in stocks, you need to invest in yourself because you need to learn, and as you know, knowledge is the power. And what are the different things you need to know or learn while you're investing in yourself? The first things is read. Read as much as you can. Read the books, financial books, newspaper, journals, articles. Take courses, whether it's an online course or in-person course. Like right now, you're taking this online course, which is pretty much 3 to 4 hours long, and you're gonna get so much out of it that you will be able to make intelligent decision and make a lot of money in stocks. Talk to people who regularly invest in stock market, like if there's you have your uncle, your aunt, your cousin, anybody who is investing in stocks regularly. Talk to them because at the end, information is the key. Then do a lot of research before you actually invest. If you're going to go invest in, let's say, Apple or Microsoft, do some research whether they are the good stock to buy, how their chart looks like. You need to read their financial reports. Yes, those are public information. You could search it online and get their financial reports. Use other market tools to perform the research on a stock that you're going to buy. Then, the best trick that I could tell you, stay invested, which is in simple term, buy and hold. Yes, if you do not invest in stocks every day, and this is not something you do as for living, then you should buy and hold. Because over the long term, the stock market news will be good. And that's what billionaire investor Warren Buffett always says. And what he wrote in New York Times, in the 20th century, the United States endured two world wars and other traumatic and expensive military conflicts. The depression, a dozen or so recession and financial panics, oil shock, flu pandemic, and the resignation of disgraced president. And look at that. Yet the Dow still rose from 66 to 11,497, which the reason he said all that, which actually proves if you buy and hold, you will make money. All right, then diversify your investment, which means don't put all your money into one stock or bond or invest in multiple entities in the same industry. For example, maybe you're just investing in tech, maybe you're just investing in car industry. As people say, don't put all your eggs in one basket. You gotta invest in different stocks. So if one industry goes down, you're still saving money or making money in the other industry. And last but not the least, don't invest everything. So let's say if you have $10,000 saved, please don't take that entire 10,000 and deplete your savings. And of course, don't borrow to invest in stocks. That's not a good idea. In this video, we will talk about the truth of stock market. First thing first is you cannot get rich quickly. There is no overnight scheme that I'm going to tell you or teach you that you'll become rich. People who become rich are simply purely lucky. They maybe buy a stock or they maybe buy a cryptocurrency and overnight it has quadrupled or it become 1,000 or 2,000% more than the price that you paid. Maybe you are that one of the million person or lucky person who become rich. Otherwise, there is no such scheme or that I'm gonna sell you for you to become rich quickly. So, same way, there are no shortcuts. There isn't a book that I'm going to tell you. There isn't a specific course, even just my course, taking this course and then start investing and you're going to make a lot of money. No, I'm not guaranteeing that, but I one thing I am promising you is it will help you a lot to make wise decisions when you're investing in stocks. All right, don't try to beat the market. 80% of people or more lose money when they make assumptions. When I say assumptions, it is without you knowing about the company, without you learning about their financial charts, without knowing their financial history. You're just assuming that the stock will go up or go down. Then you are in one of those 80% who will lose money. You cannot time the market. You cannot say, hey, I think the market will go up tomorrow and I'll sell. I think the market will go down tomorrow and I'll buy. No, you cannot. If you are not a risk taker, then do not invest in risky business. Yes, I repeat, if you do not like to take risk, then why do you want to invest in penny stocks? Those are the most risky businesses. Day trading is not for everyone. Yes, the people who do day trading, they go through a lot of stress, by the way, and a lot of number of years of experience. So if you're coming into the stock market for the very first time in your life, then first you need to learn about the stock market before you start trading every day. You will lose money if you don't know what and where to invest. So a friend of you come to you and ask you to invest in XYZ company and you do, then again, you most likely lose money if you do not do your due diligence and do proper research about that company before you invest in it. Money makes money, of course, if you invested in 1,000 in a stock and that 10 it goes 10% up, you only make $100. As opposed to you have 100,000 invested, then you make a lot of money, right? 10%, 10,000. So as you accumulate money, you will make a lot of money. And the last thing is the stock market prices are simply determined by the law of demand. So you probably see one of the stocks of one company actually went way up. It's just because bigger sharks have probably invested a lot of money in that stock, which actually changed everything about the stock and its value significantly went up. It's all about law of demand. And if a company or if those bigger sharks sell everything they have, all the holdings they have in a stock, that stock will drop. So these are the few things that I wanted to talk to you about the stock market.
All right, so let's get started. One of the most important things in life is mindset. Same goes for investing. Your mindset during your 20s is going to be different from when you're in your 30s. That's because you're going to learn from your experiences and your responsibilities and obligations are going to change over time. As you progress in your life and approach retirement, your mindset is going to keep changing. This is because your risk tolerance is going to change. When you're young, you have the ability to take on more risk. But as you progress in your life, your risk taking ability may change due to circumstances and life obligations. However, I'm not going to tell you in this course that you have to be risk averse. Rather, I'm going to tell you that you have to take on risk to achieve your goals. So, bigger your goals, the more risk you might have to take. As they say, greater the risk, greater the reward. But no one's going to come and tell you the greater the risk of loss. We hear fascinating stories of how some of the greatest investors took on a lot of risk and achieved great success. But we never hear about all those who took on similar risk but failed, because no one publishes stories of people who failed. If you want to experience it, just go stand outside a casino and you will see more people leaving unhappy than happy from their wins. The objective of this course is not to teach you to gamble, rather, how to invest wisely and trade by taking calculated risks so that you can be successful. You must have heard the saying, cash is king. But my question to you is cash really the king? So let me ask you a rhetorical question. Have the prices of goods and services gone down over the past 5 to 10 years? The answer is no. The prices of houses, new cars, food, travel, services keep rising over time. Plus, the governments around the world have the ability to print more money. So, over the long term, there is one thing that's guaranteed based on our past experience: cash is going to lose value. So, you are going to learn in this course how to invest by taking risk so that we have our cash working for us rather than it working for big banks. Finally, the difference between an investor versus a trader. In the next slide, I will show you the most richest people in the world. These are the people who have taken on challenges and risk in their lives. They are the richest people in the world because they invested their time, skill, effort into their businesses over a long period of time. As soon as their businesses became successful, they didn't just trade it for another one. Rather, they stuck with it and they took it to the peak in the world. So my objective is to teach you to be disciplined investor so that you can build your wealth over time and take on some opportunities as they present. So this is going to be our balanced approach for the long-term success. Let's move on. All right, so let's move on. Richest people in the world. At the time when I'm preparing these slides, these are the richest people in the world. You may know some or all of them. Elon Musk is the founder and CEO of Tesla and SpaceX. He created and sold PayPal, and the money that he got from it, he invested all of that money into 3 businesses. Today, he's the richest man on earth because he focused on innovation and he came up with an electric car when companies like Toyota, GM, Ford, Volkswagen, that are the largest producers of cars, didn't do it. Some of the Teslas go from 0 to 60 in less than 4 seconds, challenging some of the fastest, most expensive cars on earth. Jeff Bezos, he's the founder and CEO of Amazon. He started selling books online from his garage. And today, anything and everything can be found on Amazon's website. Other than selling things on their website, they're into streaming business, cloud computing, and even pharmacy, and many other businesses. On this list, we have Bill Gates, founder of Microsoft. Its software like Windows and Office are used all around the globe. We have Larry Page, who's the founder of Google. Google is used for search all around the world. People go on Google to look at the trends, search anything on the web, and all over the world it's used. Now, what do all these people have in common? They created a product and took their businesses public and held on to the shares. Now, so the wealth that they have accumulated is by holding on to the great businesses that they created and they believed in. Many investors create great products, but more often than not, they sell them at a great price to big companies. Big companies or wealthy investors don't care about paying a little bit of higher prices because they see the value of some great products can bring to their businesses. But once you find a good company and you hold on to that investment, and if you see the trend that the company keeps on doing better and better every year or every quarter, and they're generating more revenues and more earnings, then those investments are going to pay off big in the future. Now, say you invested $1,000 in Amazon when it went public in May of 1997. Today, that $1,000 would be worth over $2 million. Let me repeat that. Today, that $1,000 would be worth over $2 million. You can go online and search through the richest people in the world, and you will not find names of traders, people who buy and sell shares, right? Why? Because the richest people in the world are the ones who created good products, they held on to their businesses, and they reinvested those profits into making their businesses even bigger. So in this course, my focus is going to guide you how to invest for the long term so you can build your wealth over time. But we will discuss about some trading opportunities and how you can exploit them in the short term to make some quick trades and generate returns for trading. Economy versus the stock market. Economy is the production and consumption of goods and services. It encompasses everyone within it, such as the government, public or private companies, and individuals. What does that mean? It means that everyone within the boundaries of a country or a town are part of its economy, whether it's the government, companies, or individuals. On the other hand, stock market is made up of all the stock exchanges where stocks or shares of public companies are traded. What that means is stock market is used in a broader sense, and there could be multiple stock exchanges in a country. For instance, in New York alone, there are 2 stock exchanges, which are New York Stock Exchange and NASDAQ. On the slide over here, I have a picture of New York Stock Exchange, which is on Wall Street, and NASDAQ, which is in Times Square in New York. Overall, there are 13 stock exchanges within the US. There are 8 active stock exchanges in India. So it is not uncommon to have more than one stock exchange in a country. Stock exchange is where investors can buy or sell shares of companies. Buying a share of a company means you're buying a small piece of that company. In the previous video, we saw Elon Musk is the richest man. Now, say you believe in Tesla and you want to invest in the business. You can buy as little as 1 share to invest in that company. Shares of many companies are traded on the stock exchange. If buyers are willing to pay a higher price to buy a share than the immediately preceding transaction, it will drive the price higher. On the flip side, if the buyers don't bid up and sellers try to sell to the best possible offer, which is lower than the current price, it will drag the price lower. These transactions occur throughout the day, and at the end of the day, we see whether the stock market went up or down during that day. It is the trading of buyers and sellers that determines the change in price. So after all that, the question is the economy and the stock market the same thing? The answer is no. Remember, stock market is not the economy, and the economy is not the stock market. It may seem that the economy is poor and the stock market keeps going higher, or conversely, that the stock market is falling while the economy looks healthy. Stock market is a leading indicator of the economy. If the stock market is going higher, it shows the strength of the economy and the coming times in the future. But during a short period of time, they can seem disconnected. But over a long period of time, stock market will not keep going higher if the economy isn't strong enough. In this picture, you can see runners and spectators. All these people are in the same city or area. They're all interested in that race, but some are participating in the race while others are not. We cannot look at a spectator and assess the runners. Similarly, certain companies or businesses may be hurting while the stock market keeps rising, and we have seen that during the past 2 years in pandemic. Many mom and pop stores and even large companies had to shut down their businesses. This chart shows the performance of S&P 500 and coronavirus cases. S&P 500 is an index or a basket of top 500 companies that are traded in the US. S&P 500 is sometimes synonymously used as the market. The blue line shows how S&P 500 performed when the pandemic started. It dropped a little over 30% in a very short period of time. But as the cases were rising, the market started going higher. There were many large institutions or investment pundits who came out and said that the economy is headed into a depression. But every single day, the market would ignore that and continue going higher. This chart shows the recovery, how far the market came up after the coronavirus crash. So to sum up, stock market is not the economy, and the economy is not the stock market. Stock market is a discounting mechanism. It discounts the future events. It always looks in the future and tries to price the upcoming events. To give you an example, say you see a new area being developed, many high rises, malls, public transportation system being constructed. What will happen to the real estate prices in that area? They will start to rise as investors will look at the development and look towards the potential of real estate investment in that area. Many companies will try to be part of that growth. Banks, restaurants, retailers will try to establish in that area to take advantage of that growth and its future potential. Investors are always looking for value and what businesses will benefit from in the future. Investment portfolio. All right, so we have been moving along nicely. We have learned about the stock market, S&P 500, which is an index and used to gauge the performance of the stock market, and then the sectors of S&P 500 and the industries and companies that make up those sectors. So now let's discuss about an investment portfolio. An investment portfolio consists of all your investments. Those could be stocks, bonds, real estate, or a business. But what do you need to keep in mind when creating an investment portfolio? This is the most important step, which is planning. If you fail to plan, you plan to fail. This is where you really need to do a SWOT analysis, which means knowing your strengths and weaknesses and what opportunities and threats are there in the market. Obviously, if you're just starting out and have limited amount of money, you have limited options. You can start a business at a small scale, but if you're looking to buy real estate, you might not have enough cash to make the down payment. This is where the stock market comes in. With the stock market, we have great option to invest in businesses that you're interested in, and even when you have small amount of investments. As you have seen in previous slides, there are many sectors, industries, and companies to choose from. Say you would like to start a restaurant business, but it requires a lot of money, which you may not have at the moment. You can simply buy stocks of restaurants such as McDonald's or Domino's Pizza. Or say you would like to invest in a rental property. You can simply buy real estate investment trusts or REITs, as we call them, which are traded on the stock market. There are hundreds of REITs that are publicly traded, such as residential, office buildings, industrial facilities, shipping and storage, or even data centers. You can just buy stocks of these real estate investment trusts and start collecting dividends from day one. Thus, you don't have to deal with tenants, leaky toilets, vacancies, vandalism, or even managing your properties. So what you need to plan for is, why are you investing? Are you investing for capital appreciation, or to generate income, or just simply to protect your capital or preserve it? Say you're young in your 20s. This is the time when you can take on more risk in your life. So in your 20s, the ideal choice is to invest in capital appreciation to grow your money. But as you get older and get closer to retirement, you may want to protect your capital and generate some income while not taking on a lot of risk. So at that time, you may want to switch your portfolio over from stocks to bonds so that you can preserve your capital and generate a little bit of income. When analyzing your portfolio, you can't just look at assets that make up your portfolio. Rather, you also have to keep in mind if you have any leverage or debt. Sometimes people become too aggressive and take on too much debt, or when they're investing in stocks, they start borrowing from the broker to buy more shares. But remember, leverage is a double-edged sword. When it's working for you, you're making really good money. But if things turn south, you don't have adequate risk management in place, you can lose your principal as well as the value of your stocks go down. Bubbles in the stock market or real estate are created and crashes occur due to leverage or greed. Finally, you should have a holistic view and take into account all your investments, assets, and liabilities. Plus, you should also take into consideration any future obligations that might be coming up, such as your kids' college education or a wedding that you would like to pay for, or even if you're close to retirement. This way, you can make sure your portfolio is structured to meet your current and future needs.